Hi all, welcome back. Today we are going to discuss about purchase consideration during a consolidation of a subsidiary. So before that, let's consider our working number three, which is normally therefore our calculation of goodwill during a consolidation. So, what is goodwill? Basically, like when we go for the calculation, we will be like something I am buying from a particular subsidiary. Okay, let's say that I'm buying a net worth of 80,000, but I'm paying more than that because it has some other benefits. So it could be either internally generated brand or something, or it could be something other than like the value that is being placed on a particular company, or the customer is seeking this particular company because of some X factor in that particular company. So that is what goodwill is. But in order to quantify this particular goodwill, we need to see like we are acquiring a particular company, because internally generated goodwill cannot be recognized as per IFRS 3 business combinations. So as per this, let's see what is a calculation. So we'll have to first do what is your parents holding. Okay, parents holding value. So normally this will be calculated as a fair value. Parents holding fair value you need to calculate. Then you need to add what? You need to add the value of non-controlling interest. What is a non-controlling interest? Non-controlling interest is, let's say if I'm acquiring a company 80 percentage over here, so I am holding on to 80 percentage and there is like 20 percentage other people. So you need to see what is the value of non-controlling interest at acquisition date. So when you are acquiring this at the acquisition date, what is the value of the non-controlling interest? That also you need to consider. Okay. Now, by adding these two together, you will get a particular value. From that, you have to minus or subtract what is your net asset value of the subsidiary. Basically, we are looking at a subsidiary. So net asset value at acquisition, basically. So at the acquisition date, what is the net asset value we are having? So that you need to minus. So assuming that you have a parents holding of, let's say at the fair value, whatever parents holding, or the other thing is like you are considering this, what is the present value you have paid out for the purchase consideration. So it could be like purchase consideration as well. So fair value of purchase consideration also you can consider. So parents holding at the fair value at the acquisition or purchase consideration at the fair value, add your non-controlling interest at the acquisition date, and then from that you will be minusing the net asset value of acquisition date. So normally this will be coming from your working number 2 on your consolidation. Okay, so we'll get back to that. Okay, on other videos over there. So net asset value at acquisition date. Now, assuming that you all already have the values for this parents holding, so assume that you have a purchase consideration. You have spent out 500,000. Okay, in dollars. So let's consider this in dollars. So 500,000 you have spent, and non-controlling interest at the acquisition date value seems to be like 150,000, or to a reliable measurement, let's consider for 100,000. Okay, the total value of that particular company now, the total value of that particular company now would be how much? It would be the total of this 500,000 plus 100,000. We have 600,000 in total. Now, from this 600,000, what you need to do, you need to minus what is the net asset value at the acquisition date. Now, we are assuming a particular figure here. So, we have to minus it. So, I'm putting in minus, assuming that 400,000 was my net asset at the acquisition date. Okay. Now, I need to consider what would be my goodwill. So, I need to minus what 400,000 from 600,000. Since I already put in minus figure, I'm just going to add these things together. So I add these two things together because one is a negative figure. So this 200,000 is something called your goodwill at acquisition. Note to be made here. It is a goodwill at acquisition, and the question normally would be coming for what would be your goodwill at reporting date. So what is your reporting date? I'm just putting in XXX over here. So what is the goodwill at reporting date? There would be something called an impairment in some cases. Okay, impairment of goodwill would be there in some of the consolidation questions, which you need to subtract or less from this particular figure. Now let's consider our impairment of goodwill for this particular thing as, let's say, 50,000 has been impaired. So I'm just putting in, since it is need to be deducted, so I'm putting in 50,000 as my negative figure over here, and I need to subtract. So at the reporting date, what happens? At the reporting date, your figure becomes 150,000 for the goodwill. So you need to be extra careful on what is the question asking at. So is it at the acquisition date you are looking at, or is it at the reporting date you are looking at the value of goodwill? But we are not talking about the goodwill calculation over here. What we are talking over here is how you find out this particular value of the parent's holding or purchase consideration over here. Okay, so this is what we are going to look at. So in FR point of view, okay, financial reporting paper of ACCA, that point of view, you have 4 types of purchase consideration you can give to people. Okay, what is one? One is cash. Okay, simple. It is like cash only. Like you will be paying. I am paying out of this 500,000. Let's say that I am paying 100,000 in cash. That could be one thing scenario. Okay. Second scenario. So what we are discussing over here is purchase consideration types. We can say types. So purchase consideration types could be, one could be on the basis of cash. Second would be a share exchange. So what is a share exchange basically? So instead of paying cash, I am paying the subsidiary or the subsidiary's owner, paying the previous owners, to paying the previous owners of the company. Instead of cash, I am paying them on my company's shares, or let's say parent company's shares. So this is what is happening in a share exchange. So in share exchange, what is happening? Let's say that we are paying them, a parent company is paying the previous owners to acquire their particular share. We are paying them our own shares, the parent shares, on a particular proportion that would be decided during the acquisition agreement. Now the third one is something called as a deferred consideration, which is like a delayed payment. Okay, so delayed payment meaning like what happens is like I am assuming that I am going to pay 100,000. That is agreed, like the particular amount is being agreed. 100,000 I am going to pay, but the timing is not now, not at the acquisition date. What is happening is that you are paying after 1 year or 2 year based on the agreement. So it's not on the acquisition date. We are agreeing, or we are committing that we will be paying that on a later date. Now what you need to focus on this particular case is that, since this is a delayed payment, okay, so we need to consider the present value of these particular things over here. Okay, so what is the present value of this particular thing? So that we need to consider. So deferred, we'll see more when we are doing that question. One question is coming up, so we'll discuss that more over there. Okay, now relating to the fourth type, it is called contingent consideration. Okay, contingent consideration. So what is contingent consideration? It is again a delayed payment. It's similar to deferred consideration only on the basis that it is again delayed. It is to be paid after, like, let's say 1 year after, okay, or 2 year after as per the agreement, but it will be only payable on fulfillment of something, some conditions or some happenings. Okay, so let's put some conditions over here. So if it is being fulfilled on a future, let's say that if the company is making, if the subsidiary company is making this much profit, I am ready to pay this much. So that is a contingent consideration we'll be looking at. But from the point of view of FR, okay, this contingent consideration, fair value at the acquisition they would give. Okay, but however, we will be just considering how to calculate that as in our question also. So just again repeating once more what we have covered so far. We have just looked into like what is a working of a goodwill, working number 3, which is usually the working number 3 for the goodwill calculation. So goodwill at acquisition is calculated by adding parents holding and non-controlling interest at acquisition date and deducting what is the net asset value at the acquisition date from it. So we'll get a goodwill at acquisition. From that, you will be minusing any impairment there is. So you have to minus the impairment to arrive at the goodwill at the reporting date. Now coming to the purchase consideration types. Now coming to the purchase consideration types or the parents holding, it could be like 4 types. One is a cash, second one is a share exchange, third one is a deferred consideration, and fourth one is a contingent consideration. Again, only the difference between a deferred consideration and contingent consideration is that deferred consideration, contingent consideration, both are delayed payment, being I am agreeing on the acquisition date or acquisition agreement that I'll be paying a particular amount delayed, like within 1 year or after completing 1 year, after completing 2 year. Okay, the only difference is that for the contingent consideration, it would be based on some conditions to be fulfilled. So once you fulfill that particular conditions, then it is okay, you will be paying that particular amount. So liability would be there on the successful completion of that particular, or our expectation of whether we'll be paying that or not. Okay, so let's consider a particular question over here. Okay, so I hope this particular thing is visible. Let's consider, okay, a company A has agreed to acquire 80% of the equity shares of company B, a subsidiary, as part of its expansion strategy. So meaning like I am going to acquire, company A is going to acquire company B 80% basically. Okay, now let's consider the first thing. Okay, we are looking at values. Okay, so 4 thing is being given over there. I hope this is visible to you. Okay, so for the first one, the cash payment, so fair value, or we'll just note down not value. So let's consider it as a fair value. So fair value of this particular consideration, first element in this particular thing is a cash payment, an immediate cash payment of 500,000. So for the cash payment, we'll be considering that same thing over here. So it would be 500,000 again. So same amount, cash, fair value of cash is cash only. So that is being noted. Okay, that is correct. Now coming to the second part, it's a share exchange. Okay, share exchange. What is the share exchange happening over here? Company A will issue 1 share for every 2 shares held in the company B. Okay, meaning that I am going to purchase, if I am going to purchase 2 shares from company B, I need to issue 1 share. And the market value of company's A share, so meaning the parent company shares is 10 per share and company B has a total of 200,000 shares in issue. Now for the second part, we need to calculate further. What all things we need to calculate? Okay, how many shares of B is company A acquiring? How much they are acquiring, we need to consider. So we already know that they are acquiring how much? 80%. So we need to get the number 80% of the total holding. So let's consider over here what is the total holding. 200,000 shares are there in company B. Out of that, I am going to acquire 80%. So 200,000 multiplied by 80%. Okay, so I'm going to acquire 160,000 shares over here. I'm going to acquire 160,000 shares over here. Now, for this 160,000 share, how many new shares company A should issue? okay, to acquire this particular 80%. So they have given you the particular proportion. What is the proportion for 160,000? So I'm multiplying that 160,000. Out of this 160,000, every two shares held, I am going to go for one share. So meaning I am going to issue a new share, okay, for every two shares. So 1 by 2, one for every two shares. So this is a proportion 1 by 2. I need to multiply that. So meaning that I am going to give 80%. I am going to issue new shares of company A, 80,000 shares. Okay. Now, what is the market value of companies A? What is the market value of companies A share? Market value of company A. Company A's shares is how much? It is dollar 10, right? It's dollar 10. So for every share 10. So what is your value of share exchange? Share exchange value is equal to 80,000 new shares you are being issuing at the market value over here. Okay, so 800,000 would be your market value over here, which I am taking to here also. So second part is 800,000 over here. I'm taking it over there as well. So let's change the color so that you understand how we have calculated this. Okay, $800,000. So $800,000 is the share exchange value over here. Repeating once more what we have done for the second part. We have done what? We have considered 160,000 shares. That is the 80% that is being acquired by, out of the 200,000, 80% acquired by company A, 160,000 shares. For every two shares, I'm issuing one new share. So 160 by 160 into 1 by 2, 80,000 new shares I'll be issuing. Okay. And for every share, the value at the market rate is now 10 per share. So you will have a share exchange value of 80,000 into 10, 800,000 over there. So that is the value of share exchange. Now let's consider the third one. Third one, what is the case? Deferred consideration. Okay. So deferred consideration, a deferred cash payment of 150,000 is to be made 2 years from the acquisition date. So you have to go for the 2 years, meaning like 150,000. It's not at the acquisition date. I am going to buy it, or I am going to give it after 2 years. So what happens is that when you are doing this for particular 2 years over here, the payment is going to happen after 2 years, 150,000. But the value now is not the same. So we need to discount it to the present value using the discount rate. So let's consider the working for third one. Okay. So what is the payment after 2 years? Payment to be made after 2 years. Payment to be made after 2 years is 150,000. Okay. And your discount rate is how much? Your discount rate is 5%. So this is what we are going to look at right now. So your this thing is 5%. So discount rate is 5% over here. Now we need to consider what is the present value factor. Okay, using this 5% present value factor at 5% for 2 years. Okay, so normally how you will consider? So you will have this concept of compounding and discounting. So compounding, you will go for 1 plus r raised to n. Herein we will be using a formula 1 divided by 1 plus 1 divided by 1 plus r. What is your rate over here? That is 0.05, 5% raised to n, number of years raised to 2. So then you will get this particular thing over here. So let's consider the value over here. So equal to 1 divided by okay, 1 plus 0.05 raised to, this is a raised to, okay, raised to 2, okay, raised to 2. You close the brackets and you will get that particular factor over here. So normally it would be this thing, 3 digits, 0.907. So what I need to get, what is the payment to be made after 2 years? So we'll be going for the fair value of deferred consideration, fair value of deferred consideration. So you will be getting this to be discounted over there. So 150,000 into this discount factor you are getting over here. So 150,000 multiplied by 0.907, you will get 136,054, which is your value for the deferred consideration. So just need to get this the same figure over here. So discounted value you will be getting from 136,054 over here. Okay. Now 136 will be noted. Now coming to the third one is done. Now fourth one again. So normally at FR point of view, it will not be like this. So FR point of view, they would be giving you what is the fair value of the contingent consideration here itself. Okay, so let's say that assuming that 100,000 is your fair value of contingent consideration, you can take that directly under the FR concept. But in a real life scenario, it would not be the case. So in a real life scenario, it would be given as a contingent consideration over here. An additional payment of 100,000 will be made if the company B achieves a profit of target 50,000 in the next year, and there is 60% probability that this target will be achieved. Okay, so let's consider how we will be calculating this particular part over here. So additional payment of 100,000 is to be made. So we need to consider payment to be made. Okay, is it after 2 years here? No, it is after next year. So after one, payment to be made after 1 year. Payment to be made after 1 year. How much is the payment to be made? $100,000. So out of the $100,000, okay, the condition is what? The condition is that if the company B is achieving a profit target of 50,000 in next year, $50,000 is the profit target. If they are meeting, then we need to pay what? Additional 100,000. If it is not the case, then there is no need to be paid. But we have to see what is the probability for that. So if there is a probability, 60% probability, so we need to consider what? Probability of payment. The probability of payment. So we are almost certain 60%, it's probable. Probability of payment is 60%. So we will be calculating what? We'll be calculating what is the expected value. This is some concept you would have learned in PM. So expected value. So expected value is nothing but what is the value, okay, that is being multiplied by your probability. Value multiplied by probability is the value. So let's consider if this is happening. The chance of happening this is 100,000 into 60% is 60,000. Now 60,000 is the value you will be getting after 1 year. So what you have to do, you have to discount it again. No, so present value factor, I'm just borrowing this from here. So 5% is the same case. So if the company is having for deferred consideration also 5%, contingent will be having that same percentage normally. If not the case, it would be mentioned in the question. So here it is only for 1 year. So 5% for 1 year. So what happened? You need to change the formula by, there is no need to. So basically it's like exponentiation 1. Okay. So here also it's exponentiation 2 was the case. So here exponentiation 1 is it's only for 1 year. So we need to calculate the present value factor for 1 year. So we'll go for 1 divided by, okay, 1 plus 1 divided by 1 plus 0.05, okay, raised to 1. Exponentiation symbol is there. So let's close it. So your this thing is 952. So fair value of contingent consideration is equal to what is your expected value multiplied by present value factor. 57,413 is your present value of, not present value, fair value of contingent consideration over here. So this is your value over here. Now this 57,143, I am going to take it to here as well. Okay. So 57,143 is taken. So what is your total value of purchase consideration? Just add up all the four factors over here. 500,000 plus 800,000 plus 136,054 plus 57,143. So this is your total consideration you would be having over here. So this is your answer. Okay, so your purchase concern, fair value of purchase consideration, which would be appearing in your working number 3, goodwill would be 1,493,197 is the figure you will be. Now what you will be having it over there. What you need to focus over here is that relating to the fourth part, which is the deferred consideration, this fair value of contingent consideration will be given in the exam for the FR purpose. I'm only talking about FR point of view. So financial reporting paper of ACCA, it would be given what is the value of contingent consideration. Now what you need to consider during the cases of 3, the deferred consideration, and 4, contingent consideration, is the unwounding of discount that is happening at the reporting date. So meaning, like, for example, this 136 is at the acquisition date. Assuming that 136 is the discounted rate at 1st January 2023 and your year end is 31st December 2023. Okay, what would be your value here? 1st January is the acquisition value only 136,054, but it would be reaching for the next year. So let's say 1 year is closed at the 2023. So since this is a deferred consideration, what is happening is that your entry would be like, you will be recording this as the investment part, but you will not be paying. No, you are not paying, you are having this liability over here. So at the date of 1st January, this thing, you would be recording 136,054 as a liability in your financial statement, liability in your SOFP, statement of financial position. Why? Because you have not yet paid this particular thing. So this liability will need to increase to 150,000 after 2 years, meaning like at 31st December 2024, after 2 years, it would be normally becoming like 150,000. So how this is happening? There is something called unwounding of discount. Unwounding of discount is nothing but, okay, what you need to consider for 1 year, since this is discounted 5%, 136 into 054 into your percentage, 5% will be increasing every year. So here it would be, okay, 136,000 plus 68072, 142,857, and similarly for the next year, this multiplied by 5%, okay, 7142, and at the end of the year, what would be the figure over here? 142,857 plus 7142, 150,000 would be the case. So this 6872 and 7142 for every year over here, okay, so it's basically like this is happening in here. Okay, so 142,857 is should be the closing figure for the liability under SOFP, and 6872 is your finance cost for that particular year, meaning this is called unwounding of discount. Okay, so this will be appearing in your P and L in every year. Okay, till when you are paying this. So 6802 would be your payment for 2023 for the first year as the interest, and 7142 would be your next year interest. So this will be therefore since this is for 2 years for the deferred consideration, we are considering these two, and for the other one we will be only considering for 1 year over here. So that is the case. So you need to be, it should be 60,000 at the end of 1 year. So that is the case. Okay. So this is relating to your purchase consideration part. I hope you have understood how to calculate each of these particular components over here. Okay. And once again, summarizing, for the working number 3 of the consolidation, we'll be having a purchase consideration or the fair value of parents holding, which may be, I'm not telling everything would be there. So for FR level, it could be either a cash payment, a share exchange, or a deferred consideration, or sometimes they will give you all four, or it could be sometimes three or two based on the question, other requirement as well. Okay, so this is how you will be calculating it. So if there are any doubts relating to this particular area, you are feel free to reach out to me. Okay, as you can put it as a comment to this particular video also, or you can reach out to me on Snuma Tutor on Instagram, YouTube also as well. Okay, so if you understood the concept, if you like my video, put a like for this particular video and subscribe to my channel for the next videos as well. Okay.